welcome to a brand new Business Week. It's Monday, the 10th of July. Welcome to the program. This is Business Morning live from Channels Television Global Headquarters. We welcome our viewers here in Nigeria and around the world. Let's start with what's breaking as we speak this morning. Nigeria and Libya has been invited to the July 24 meeting of OPEC and non-OPEC members, and that meeting in the next couple of weeks they may ask Nigeria and Libya to join the cutback of oil production. That's what Bloomberg is reporting a few minutes ago. Nigeria and Libya have boosted their oil production since early this year, when the new round of cutback, 1.8 million barrels among OPEC and non-OPEC oil producers like Russia, decided on that. That will go through the March next year. The next meeting of OPEC is on November the 30th. Now, the Kuwaiti oil minister, Issam Al-Marouk, says this morning that Nigeria and Libya have been invited to come to the meeting in St. Petersburg in Russia later this month. That will be a couple of, about 2 weeks from now. Both countries, Nigeria and Libya, they were exempted since November last year in the new package of oil production's cutback has since been ramping up. Now, the Kuwaiti oil minister says, quote, if the two countries are able to stabilize their production at current levels, we will ask them to cap as soon as possible. We don't need to wait until the November meeting to do that. Now, that is very interesting news that we're waking up to this morning. If Nigeria and Libya are able to convince OPEC and non-OPEC members on July the 24th, they may be asked to cut back on oil production. Nigeria currently produces about 1.6 million barrels of oil per day. This year, we've seen Brent crude, which is Nigeria's benchmark, around 17% in the red. Today, this morning, oil prices moved up around 47 cents in London, around $46.94 a barrel at about 7:30 a.m. local time. That's the news in this morning, and that's part of the conversation we're going to have today. That's something the fiscal authorities in Abuja will be head-scratching about as we speak. Let's wake up, everyone, to what is going to be an interesting business week. And, of course, we're now technically in the second full week in the new month of July. What are some of the materials and news and events we have on the calendar? This week, we're expecting the June inflation report from the National Bureau of Statistics. This very important, backward-looking, but very technically important, forward-looking economic data will be released from the MBS before the end of the week, most likely on Friday. According to the central bank governor, Godwin Emefiele, who's been quoted in some media this morning, says, firstly, with inflation trading downwards, we are hopeful that in the course of time, we will get back again to single-digit inflation. Of course, the inflation has made nonsense of the central bank's target of about 1 to 9% inflation target. We've done 18%, but we've since been trading downwards. And Godwin Emefiele, the head of the central bank, believes that if we keep that trajectory, we may soon see single-digit inflation within the Nigerian economy as soon as possible. On July 17th, it's going to be a watershed here for Nigeria and in many countries across sub-Saharan Africa, as FMDQ OTC Securities Exchange will list the first ever infrastructure bond promoted by Chapel Hill Denham. If you missed the news last week, of course, the Securities and Exchange Commission approved the first tranche of this bond, north of 80 billion naira, that has been successfully issued to investors. Now, the multi-billion naira package, first tranche that has been successful and approved, will be going to be listed on FMDQ OTC Securities Exchange. Will be all over that next week, Monday. You don't want to miss that. This bond is very, very critical. It's going to be the first of its kind that's targeting roads, bridges, railways, and other critical socio-economic infrastructure that Nigeria is solving. It's the first of its kind in the country's history. Towards the end of the month, July 27th, of course, the deadline expires for NIPCO Investment, extending its offer to minority shareholders as the new investor seeks to increase its stake in Mobil Oil Nigeria to 70% after taking 60% of ExxonMobil of United States out of Mobil Oil Nigeria. That's the downstream arm of Mobil Oil doing business in Nigeria's oil and gas space. The deadline for the extension is approved by the SEC will now expire on the 27th. In the third week, that's the week starting next Monday, July the 17th, we expect a stream of second quarter and first half earnings from listed companies. And of course, in the same week, we expect the Debt Management Office to start the third quarter first FGN bond auction under the new Director General, Ms. Patience Oniha. That will be the first DMO debt fund that she would be floating on the market under her leadership. We're looking at that auction very closely. Let's leave the markets a bit and get into a core economic center. Maritime workers say they're going to protest tomorrow across the country against the planned tinkering, or what are called amendments to the Nigeria Ports Authority Act. That's what is in the news this morning. Tomorrow is July the 11th, and they said the protest will be across the country. What the protest by the maritime workers is all about is because the National Assembly, by this time the Senate, has passed or has read the bill has passed the first and second reading. Now it's going for the final phase. Now the Nigerian workers in the maritime sector says the move to repeal and change the Nigerian Ports Authority Act of 1955 as amended with a new one which will be called Ports and Harbours Authority Bill of 2015 is not in the best interest of the country. It says if the new law is passed by the Senate and also ratified by the lower house of legislature, the Nigerian government will suffer revenue as well as job losses to their members, as well as some insecurity measures, including concessioning. That's some of the stories we'll look at. What's the problem there? Of course, last